Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good morning.
For this week's deep dive, we've sifted through the latest from the Wall Street Journal, MarketWatch, Bloomberg, the usual suspects.
Right. Trying to make sense of it all.
Exactly. We want to bring you a clear understanding of the major financial stories shaping the landscape right now and, what they might mean for you.
Yeah, the mission really is to cut through the noise.
Help you connect the dots without feeling, overwhelmed.
Absolutely. And there's a lot connecting right now. We're looking at, global trade stuff, central banks doing their thing, specific market moves. Our goal is just to unpack these headlines, pull out the key insights so you can see that bigger picture.
And think about how it affects your own financial decisions.
Precisely.
Okay, let's dive right in then. One of the biggest themes, unavoidable really, is the ongoing global trade situation.
Still front and center.
We saw a Bloomberg report highlighting that Moody's has actually increased its default predictions for speculative greed companies specifically.
That's pretty great, yeah.
So what's the thinking there? What should someone listening take away from that?
Well, what's really insightful, and Bloomberg's analysis pointed this out, is how Moody's is directly linking trade policy to creditworthiness.
Okay.
It's not just general economic, headwinds. They're specifically saying the rising chance of tariffs will likely dampen economic growth.
Right, makes sense.
Which in turn makes it tougher for these more vulnerable companies to get financing, pay their debts.
So what's the number they're forecasting?
They're looking at a 3.1% default rate by year end. And this is the part that's a bit concerning.
Uh-oh.
They think it wouldn't take a huge negative shock for that rate to potentially double, maybe hit 6%.
Wow, double. That really underscores the risk.
It does. It shows how tariffs can inject sort of fragility into the system, especially for those high-risk borrowers.
And Bloomberg also noted Moody's is assuming tariffs will shave at least a full percentage point off U.S. growth.
Yeah, that's their baseline assumption, which is, a pretty significant drag.
Definitely something to keep in mind when you're thinking about the overall economy.
It is, and it's not just the U.S., right? The Bloomberg piece noted Moody's sees this weakening other economies, too.
Ah, the ripple effect.
Exactly. It complicates things globally. Something to consider if you're looking at international investments or, big multinational companies.
Okay, staying on tariffs, there were also some interesting comments, again via Bloomberg, from President Trump regarding China. Sounded like maybe some reluctance to keep hiking tariffs, worries about stalling trade. He even mentioned the Chinese reaching out for talks.
Yeah, that was notable. It raises questions about sort of the end game here, or at least the...
What's your read on that? Could it stabilize things?
Well, look, the current tariffs are already massive. Bloomberg put the numbers out there, 145% effectively on Chinese goods, 125% retaliatory from Beijing. Huge numbers.
Right.
So the president may be hesitating to add more. Could signal a recognition of the potential economic damage.
Maybe hitting a limit?
Could be. And if the Chinese have reached out, maybe there's some mutual interest in de-escalation. Though those existing tariffs are still a big hurdle.
So for listeners, maybe the risk of more tariffs is lower, but the current friction isn't going away soon.
That seems like a reasonable takeaway for now. They'll likely keep influencing market sentiment, supply chains, all that.
And then there's another layer. The same Bloomberg report mentioned new U.S. levies on Chinese ships docking at U.S. ports.
Right, more targeted this time.
But still feels like it could cause disruptions, couldn't it? What are the potential ripples there for global commerce?
Absolutely. If you think about global logistics, hitting shipping directly like that could definitely mess with trade routes, might increase transport costs.
Yeah.
Interestingly, though, Bloomberg noted some Asian shipping stocks actually went up on the news. Kawasaki Kizun, HMM Co.
Huh. Some seeing opportunity.
Seems like it. Maybe anticipating shifts in routes that benefit them. It just highlights how these actions create winners and losers, sometimes in unexpected places.
It's like trying to game out the consequences constantly. Remember that 90-day pause on higher tariffs Bloomberg covered?
Oh, yeah. That caused quite a scramble, didn't it?
The Bitcoin mining example was wild.
Totally. It shows the immediate tangible impact. Bloomberg detailed this, a $330 million rush to move Bitcoin mining gear out of Southeast Asia.
Just to avoid tariffs that then got paused.
Exactly. And they were paying insane shipping rates, 4 times normal for air freight, 20 times for ocean.
That's desperation.
It really emphasizes the burden these tariffs represented, or were expected to represent. Then the pause made all that effort and expense, well, kind of pointless.
Highlights the uncertainty businesses are dealing with. How do you make long-term plans?
It's incredibly tough. Which brings us maybe to another angle on trade. The Wall Street Journal mentioned Treasury Secretary Bessent,
Scott Bessent, right?
indicating the U.S. is prioritizing talks with about 15 partners, EU, Japan included, moving towards specific deals maybe.
So shifting from broad tariffs to more targeted agreements.
That's what it suggests, a potentially more nuanced approach, addressing specific issues with key partners.
How might that impact things differently for, investors or businesses?
Well, the success hinges on the negotiations, obviously, but it could mean a more differentiated impact. Some industries might benefit from new deals, others might still face headwinds depending on what's agreed. Less of a blunt instrument, maybe.
Okay. Then we have Adam Posen from the Peterson Institute. MarketWatch covered his analysis, and it sounded pretty grim.
Yeah, sobering is a good word.
A 65% chance of a stagflationary recession because of trade wars. Can you unpack stagflation for us? It sounds bad.
It is bad. Stagflation, as Posen describes it and MarketWatch explained, is that nasty mix of high inflation and weak or negative growth happening at the same time.
Right, the worst of both worlds.
Exactly. Think slow growth, like the brakes are on, but prices are still rising fast, like the engine's overheating. Very hard to fix with policy.
Because fixing one makes the other worse.
Pretty much. Raising rates to fight inflation slows growth more. Stimulating growth can boost inflation. The U.S. saw it last in the 70s, early 80s. Tough times.
And Posen's worry is that trade disruption causes both. Higher prices from tariffs, slower growth from uncertainty.
That's the core of his argument, yeah. Even if deals get done, he thinks the tariffs already in place might stick around, contributing to this environment.
MarketWatch said he argues the uncertainty itself holds back spending and investment.
Exactly. He thinks that uncertainty discourages households, businesses. They hold back even if you try other things like tax cuts. He even drew a parallel to the UK post-Brexit.
Suggesting uncertainty from breaking economic ties is damaging in itself.
Right. Highlights the potential long-term fallout from major trade shifts. Something for listeners to really think about.
Okay, let's shift gears. The Federal Reserve and interest rates, always a hot topic.
Never dull.
The Wall Street Journal highlighted President Trump's renewed criticisms of Chairman Powell. Pretty pointed stuff. Termination cannot come fast enough. Criticize the lack of rate cuts.
Yeah, the tone and the public nature of it are quite striking, attacking Fed independence so openly.
What should people following the economy make of this escalating tension?
Well, the Journal noted Powell's response on Wednesday. He basically reiterated the Fed's independence and said they won't bend to political pressure, decisions based on data.
Standard Fed line, but important to restate.
Crucial. But he also acknowledged the trade conflict is complicating things for the Fed. It's part of their calculus.
So the tension itself is something to watch. Could it soak markets?
It absolutely could. The Journal touched on this. A perceived loss of Fed independence is often seen as undermining stability. If investors doubt the Fed can act freely, that could increase volatility.
Did the markets react much yet?
The Treasury market stayed pretty calm, according to the WSJ, which is a key signal. But it's definitely something that could unnerve investors if it continues or intensifies.
Right. Loss of confidence there could impact rates, borrowing costs, everything.
Precisely.
Interestingly, Adam Posen, back to him in that MarketWatch piece, had a different take on the Fed.
Oh, yeah.
He argued they might have cut rates too much already, given inflation, and might have to hike sharply later.
That's a contrarian view right now.
It is. It highlights the debate, doesn't it? Posen's worried the Fed might be underestimating inflation, and these cuts now could mean more pain later, higher rates down the road.
A different kind of risk to consider.
Yeah.
Shows how complex the situation is. No easy answers for the Fed.
Okay, let's look at the stock market itself. The Wall Street Journal reported a big drop in the Dow, mostly blamed on United Health's disappointing results.
Yeah, UNH dragged it down significantly.
What was unusual about that day's trading? What's the takeaway?
The really strange thing, as WSJ highlighted, was the Dow falling over 1%, while the S&P 500 actually gained.
That doesn't happen often.
Extremely rare. First time since 1928, apparently. It just shows how the Dow's price weighting works. High-priced stocks like UNH have a massive impact.
So the Dow's move wasn't necessarily reflective of the broader market that day.
Not entirely. The S&P 500 gave a different signal. It's a good reminder for listeners that different indexes can tell slightly different stories. Don't just watch one.
But despite that weird day, the overall week was down for all three major indexes, right?
Yes. Weekly declines across the board suggests a general sense of caution took over.
And the journal linked that caution back to trade uncertainty again.
Seems so. Early week optimism faded after those new U.S. export restrictions on China were announced. Shows how sensitive the market is to trade news day by day.
We also saw NVIDIA take a big hit, down 8.5% for the week, WSJ said, tied to trade tensions and those export rules.
Yeah, that's a significant drop.
What does that tell you about specific sector impacts, especially for tech investors?
It really hammers home how directly these trade restrictions can hurt specific sectors. Tech companies, especially those with big international footprints, big exposure to China, they're vulnerable.
Concerns about market access, supply chains.
Exactly. It weighs heavily on investor sentiment for those specific names. It shows how geopolitics can directly hit your portfolio, depending on what you hold.
Okay, but on a more positive note for one company, Bill Ackman.
Ah, yes, the Hertz stake.
Nearly 20%. And his reasoning, detailed in the journal, was fascinating, connecting the tariff environment to potentially higher used car prices.
It's a really interesting, almost counterintuitive thesis, isn't it?
And how do you read that? What does it suggest about finding investment ideas now?
Well, his argument, as the WSJ laid it out, is tariffs on new cars could push up used car values. Hertz has a massive fleet of used cars, so Hertz benefits.
Simple, but clever if it works.
Right. He also mentioned improving industry structure, a potential Uber partnership. Lots of layers. But the tariff angle is unique.
And the market loved it. Hertz stock jumped.
What was it? A huge jump. 44% on Thursday alone, the journal said. Over 125% in 2 days. Massive reaction.
Wow. And the Uber CEO apparently liked the partnership idea, too.
Adds more fuel to the fire. It really shows investors are looking for companies that might be resilient or even beneficiaries in this weird tariff environment, thinking outside the box.
A good example of strategic thinking in uncertain times.
Definitely something for listeners to mull over when looking at potential investments. Non-obvious connections.
Okay, turning to China itself. Bloomberg reported what looked like intervention by China's sovereign wealth fund.
The national team.
Right, trying to stabilize Chinese stocks amid the trade stuff. Big jump in ETF turnover late in the day.
Yeah, that late-day buying by state funds is usually seen as an effort to put a floor under the market, prevent big slides, manage sentiment, especially when things are tense like now.
Does it work?
Well, the Shanghai Composite did manage its 8th straight day of gains, according to Bloomberg, despite pressures. So maybe it's helping moderate volatility, at least short-term.
Interesting. Shows how governments can step in, especially in emerging markets.
It's a factor to be aware of, for sure.
Speaking of emerging markets more broadly, Bloomberg also said EM stocks and currencies had their best week since early March.
Yeah, bit of a relief rally there.
What drove that?
Mostly optimism about China's economy, maybe holding up better than feared, and also linked back to Trump's comments about maybe not hiking China tariffs further.
Ah, so the easing of trade fears again.
Exactly. Even a hint of de-escalation can be a positive catalyst for EM assets. Commodity currencies like the South African rand did particularly well, Bloomberg noted.
Shows how tightly linked EM performance is to the U.S.-China dynamic.
Very sensitive, yes.
And also on EM, South Korea is planning to issue more overseas bonds to fund currency intervention.
That's what Bloomberg reported. They want to boost their firepower to respond if the won gets too volatile because of, well, U.S. tariffs again.
So they're preparing for potential instability caused by trade policy elsewhere.
Right. It shows the pressure smaller, open economies feel, and the steps they might take to protect themselves.
Okay, let's bring it back home. The U.S. housing market. MarketWatch had a piece on a cooling trend in some areas.
Yeah, higher mortgage rates starting to bite.
Seeing more price cuts, homes sitting longer. What are the key takeaways for someone thinking about buying or selling, or just watching the economy?
MarketWatch paints this picture of the market definitely feeling the higher borrowing costs. Nearly a quarter of Zillow listings had a price cut in March. That's the highest in 7 years.
That's significant. Sellers adjusting expectations.
Seems like it. And they mentioned specific cities, Jacksonville, San Francisco, Austin, Dallas, some others, where Redfin data showed median prices lower than last year.
So actual price drops in some markets.
Yes, which means, if you're buying, maybe more negotiating power. If you're selling, maybe you need to be more realistic on price, expect it to take longer.
And that jump in the 30-year fixed mortgage rate average hitting 6.83%, biggest weekly jump in a year, that's got to be dampening demand.
Oh, absolutely. MarketWatch linked it to falling mortgage applications. That kind of rate increase really impacts affordability.
Pushes some buyers out, forces others to lower their sights.
Exactly. And interestingly, the article ties the rate rise itself partly to market volatility, geopolitical tensions, and guess what?
Uncertainty over tariffs.
Bingo. It all connects. And homes taking longer to sell 47 days on average in March, longest for March in 6 years per Redfin. Another clear sign things are cooling.
Definitely a shift in the market dynamic.
For sure.
Okay, finally, let's touch on that other MarketWatch article, asking if college is still a worthwhile financial investment.
A really important question these days.
Citing a New York Fed report saying, maybe surprisingly, college does not pay off for everyone.
Yeah, that's a striking statement. It challenges the old assumptions.
What were the key findings people should know if they're thinking about college for themselves, their kids?
Well, the article notes that overall, a degree still offers a decent ROI, like 12.5% in lifetime earnings in 2024, but
It's a big but.
the lowest earning college grads now make about the same as a typical high school grad. That's a huge caveat.
So it's not the guaranteed ticket it once was.
Seems less guaranteed, or at least more variable. It suggests you need a more nuanced look at the costs versus the potential benefits.
And the article stressed the huge difference in ROI based on major, right?
Absolutely crucial point. Engineering, math, computer science, business, economics, generally much higher returns. Education, liberal arts, leisure hospitality, much lower, financially speaking.
So what you study matters immensely.
It really does. The article quoted Zach Mabel from Georgetown Center on Education in the Workforce.
What was his advice?
He basically said, view college as an investment. Investments have risks, no guaranteed payoff, which feels very relevant with rising tuition and student debt.
And growing interest in skilled trades as alternatives?
Right. It reflects this shifting perception. It means you really need to evaluate career goals, potential earnings for different paths much more carefully now.
MarketWatch ended with 5 practical questions for prospective students.
Yeah, things like, what are your career interests? Can you afford living costs while studying? What education does your desired field actually require? What's the ROI for specific schools or programs? How long will it take?
A much more strategic approach needed.
Exactly. As Mabel said, it's not a guaranteed ticket, so do your homework before investing all that time and money.
Okay, so wrapping up this deep dive. We've really seen how these global trade tensions are just casting a long shadow, creating uncertainty, hitting various sectors from manufacturing to crypto mining.
It's pervasive.
The Fed's actions, its independence, remain under a microscope, especially with the White House dynamic.
Constant scrutiny there.
The stock market's been choppy, reacting to company news like UNH, but also heavily influenced by trade headlines like with NVIDIA or investor bets like Ackman's on Hertz.
Lots of moving parts.
We saw emerging markets react to trade whispers, the U.S. housing market cooling under higher rates, and even this fundamental reassessment of college's value.
It really underscores how interconnected everything is. Trade policy affects mortgage rates, affects housing, affects consumer confidence.
Exactly. It all shapes the financial landscape you're trying to navigate.
Hopefully this overview gives folks a clearer snapshot of those big narratives and how they weave together. Helps you stay informed, think critically.
Well, that's all the time we have for this Friday's deep dive into the major financial magazine headlines. We hope this has provided you with valuable insights and a clearer understanding of the key trends shaping the market.
Hope it was helpful.
And that we'll see you all Monday morning with new headlines from major financial magazines.